After 10 years of helping clients structure their retirement with portfolios worth more than $10 million, I've seen what actually separates wealthy people versus those who run out of money. So here are the 6 steps that you can use to have more than enough money during your retirement. Here's step 1. Figure out your real number. There's a client named John that I've worked with for a long time. He recently turned 60 years old, and he has a net worth of about $7 million, and that does not include his home that's paid in full. Now, he does not own a business. He has built his net worth by being extremely disciplined over the years and saving money consistently. Now, I recently met with him to talk about his retirement, and we talked about him hanging it up in about 5 years at the age of 65. He said that he and his wife could live off about $12,000 per month and feel like kings and queens. He thinks that that's more than enough money during retirement. $12K per month comes out to $144,000 per year. So we started with that number, but I increased it by a lot because I think he's going to need more than that as the years pass. Most people want to do things during retirement that they didn't get to do while they were working because they didn't have the time, like traveling, having fun, all that stuff, that costs a lot of money. So as you near retirement, start by tracking your spending. It can be 3 months to start. This way, you can really get an understanding of what you're spending and where your money is going. Write that number down so you know how much income you'll need when you retire. Then add 25 to 35% to that number, and we'll call it a boredom tax, just for fun. Whatever the number is that we come up with, we'll call that your target income. That's step 1. On to step 2. Calculate your guaranteed income sources. John's need was $12K per month, which is $144,000 per year. The first thing we did was look at his fixed floor, Social Security for him, his wife, and then he also has a pension that will begin when he turns 65. We added those up, and it came out to $140,000 per year. What we ended up doing, though, is planning for about twice that amount, about $290,000 of income. Now, a big reason why we did this is because we've seen inflation over the past several years just skyrocket, and we wanted to set that number so high that he would never have to think about dipping into his assets during retirement because he wants to continue to grow those. So here's what I would do. First, I would get your Social Security statement, regardless if you think it'll be there when you retire or not. I would still get that statement so you can see what the number is. Then I would get information on any pensions and guaranteed income annuities you might have. And if you have income producing real estate, you can throw that in there as well, but I might shoot it conservative depending on the type of real estate that I own. When you add them all up, that's your total income. And if there's a gap between your total income and your target income, then we know that we need to restructure some of your assets in order to fill that income gap. Let's move on to step 3. Figure out where your money is and how much belongs to you and how much belongs to the IRS. Something I learned, though, that helped me a lot was breaking money into 3 different buckets: a taxable bucket, a tax-deferred bucket, and a tax-free bucket. A taxable bucket consists of any accounts that are taxable, meaning I'm paying taxes on the gains. Could be CDs, money markets, treasuries, and you could put stocks in there as well. Stocks are treated differently. I usually pay taxes when I sell some stock, but I still put them in a taxable account bucket. Then we've got tax deferred. So tax deferred means that I'm not going to pay any taxes on the account balance while it grows. And if it's something like a 401k, I also don't pay taxes on the money I put in. I can deduct my contributions to a 401k. So I don't pay taxes on what I pay in. I also don't pay taxes on the growth. But when I eventually take that money out to spend, I have to pay taxes on everything. If we look at John's net worth, it's $7 million. And he had everything categorized, so it was very easy to create these buckets. In taxable accounts, he had about $3.2 million. In tax-deferred accounts, he had about $2.3 million. And in tax-free accounts, he had about $1.3 million. The thing is, about John, when he dies, he wants to leave as much money as he can to his family instead of the IRS. So with that goal in mind, the problem he had was that he had about $2.3 million in the tax-deferred bucket, meaning no taxes have been paid here. So he's got $2.3 million, and he's got 2 kids. Let's assume he has a $1 million IRA, and that goes to John Jr., okay? So we got Jr. over here. How much does Jr. get of that $1 million when he dies? He doesn't get $1 million, I'll tell you that much. So because no tax has been paid on this, remember, it's grown tax deferred, so nothing's been paid. If it goes to Jr., Jr. has to pay income tax on the full $1 million. And if Jr. makes any money, if he earns $100K per year, and then he gets $1 million from an IRA, guess what? His taxable income that year is $1.1 million. Now you could stretch an IRA and receive payments over time, but he's going to pay a lot of tax on this. If he ends up paying 40%, which he would if he takes it in a lump sum, that means he walks away with $600,000. Being that John's goal was to leave as much money as he can to his kids and not the IRS, it is not efficient at all for him to leave money in the tax-deferred bucket. Now, this is important because a lot of people will often overestimate their wealth because they don't account for the money that has to go to the IRS. So for John, this changed our approach a lot when determining what accounts we wanted to use to fill the income gap and hit the desired target income. And then we left the rest, or we're planning to leave the rest, to his kids eventually. Okay, on to step 4. Decide what happens to your wealth once you die. For John, his goal was not and is not just spending money. He really wants to create a family legacy. So here's how it works. We've got John today. Now, if he and his wife get into an accident, what they don't want to happen is for this $7 million just to go to their 2 kids. It could ruin them if they just get big piles of money. So what they'll do instead is have the money go to what is called a trust. And to make this very, very simple, because trust planning can be complicated and a lot of people just shy away from it, is what it does is specify exactly when the kids can access money, how they can access money, what they can access money for, and you can even make it creative. So having a trust in place that prevents irresponsible decisions from being made ensures that the money stays in the family. That's the key. This keeps wealth inside the family. So if John's alive, he's very responsible. He knows that he can continue to grow the family net worth. But if he passes, no one else is doing things like he is. And that is where wealth can disappear within families. You know what's interesting is if you look at wealthy families, about 70% of them lose their wealth by the 2nd generation. And it's about 90% of wealthy families losing their wealth by the 3rd generation. So the concept of a family office or using a trust, what I like about it a lot is that it puts responsibility into the picture. How you've grown the family net worth, you can keep those principles and laws in place in writing in the trust that you set up. And it makes legacy planning more than just about leaving money, it's about passing down values. On to step 5, convert a portion of savings into a guaranteed income. For him, peace of mind was everything. When he retires, he does not want to have to worry about checking his account balances and investment accounts all the time. No, he wants to enjoy himself. So we looked at several options, but the one that he liked a lot involved moving about $1.3 million into income annuities. And of that $1.3 million, there were 2 IRAs that were part of the tax-deferred bucket. So here's what we did. We took $1.3 million today at his age of 60. So he's 60 years old today. We moved that into annuities, 3 of them specifically, 2 on him and 1 on his wife. And then at age 65, those annuities start to pay income. Guess how much they're going to pay him? Is guaranteed too, by the way. About $150,000 per year. Do you remember what his guaranteed income was that we went over earlier? It was $140,000 per year. That was the combined amount between his Social Security, his wife's Social Security, and then also his pension. So we've got the $140 that he can bank on. The annuities are with A-rated companies. He can bank on that. Add that together, what are we at? $290,000 per year. And we're spending a lot of that tax-deferred bucket as well. So now he does not need to worry about passing that to the next generation and seeing a big chunk go to the IRS. So that $290 per year for him was huge because it completely eliminates the thought of needing to dip into his accounts to supplement his income. He has no concern about a market crash or anything. Like, he's not going to live in fear during retirement because that's almost twice the amount he needs. Remember, he said $144,000 initially. But the thing is, if he ends up not spending anywhere near that, say he spends $200K per year, the other $90K, he could just take that and put it back into different accounts that he likes the most. So it makes things very flexible for him. Here's the thing. You don't need $7 million like John has to make this work. This was just a very recent case I worked on where we got to break everything down together, and I had a ton of fun with it as well. But there's a lot of people that we work with on a regular basis that will convert $100,000, or maybe it's $250,000 of their savings into guaranteed income. Finally, run conservative projections to see your net worth. So John is one of the most conservative people that I know. I've worked with him for almost 5 years now. When we projected the $5.7 million growing for the rest of his life, because remember, we took 1.3 and put it into annuities, guess what growth rate we used? 3% and then also 4%. Why this is so conservative is because he has a money market right now earning more than that. So he's going to do better than 3 or 4% per year. But with that said, I kind of like running it that conservative. And the reason why is because if the numbers look good from a projection standpoint with conservative assumptions like that, you're going to be absolutely thrilled in the future when it does better. We're setting expectations down here and reality is probably up here. The thing is, when we finished everything for John, we had the following results. From 60 to 65, he's still contributing to his different accounts. So that $5.7 million is going to grow quite quickly over the next 5 years. At 60, right now, we're looking to move $1.3 million into annuities. And then at age 65, he's got Social Security, his wife's Social Security, his pension, and those 3 annuities, which gives him a combined annual income for the rest of his life, starting at 65, of $290,000 per year. And then his net worth at a 3 to 4% assumption grew to, guess what? At age 85, it was $21 million. And if he makes it to 90, it was $25 million. The thing is, he's actually going to pass more than that because he has a big whole life insurance policy, and the death benefit is and always will be greater than the cash value. Now, if you're younger, I wouldn't do any of that. I would focus on one thing, and that's saving money. What I would try not to do is waiting until I'm 64 or 1 year before I retire or even look at everything. If you'd like specific tax strategies that can potentially save you hundreds of thousands of dollars, I'd check out this next video.